the first talk of the day, the first panel, a topic I think very prevalent, very much in the news, tokenization and real-world assets. So I'm very excited to introduce the first panel today, RWA, the trillion-dollar institutional infrastructure layer. Wow. So if I could get the panel up here, and I will introduce you to your moderator for today. That will be Michelle O'Connor. She's the Global Marketing and Communications Strategist at GBBC. So Michelle, I will hand over to you and the rest of the panel. Thank you.
Good morning. Thank you for being here early. We appreciate it. And thank you to Paris Blockchain for a great day. Our panel today has 40 minutes of a rather deep conversation, but we promise to keep it interesting. I'm going to invite panelists to introduce themselves. Go ahead.
Thank you. So my name's Nenter. I am currently the global CEO of BitMart Exchange. We've been around for the past 8 years. Prior to that, I spent about 17 years in traditional finance as a banker. Most recently spent my last several years as a partner at Animoca's venture fund based in Hong Kong. Very pleased to be here.
Hello, everyone. I'm Ronghui Gu. I'm CEO and co-founder of CertiK, one of the largest Web3 cybersecurity firm. We basically do code auditing, penetration testing, and so on. I'm also a computer science professor at Columbia University. Yeah, thank you.
Hello, good morning, everyone. I'm Abel Peña, CSO of Bit2Me. We are like a Spanish exchange. We've been over a decade serving individuals, companies, and institutions.
My name is Darko Hidukovic. I'm head of digital markets infrastructure at London Stock Exchange Group. And I have to say, I landed exactly 1 hour and 10 minutes ago, so I'm not normally this red, but I was running.
You made it. That's the most important. Good morning, everyone. My name is Arnaud Simeray. I lead the go-to-market and institutional team at Dune. Dune Analytics, not the movie. We are the leading on-chain data platform. Think of us as Bloomberg, but for the on-chain data. We serve data to regulators, institutions, as well as pretty much the entire industry.
Thank you. So I think as we set the stage looking at not if, but when, right? And over the past decade plus that I've worked in this space, it was always when things go on-chain and the promise. We surpassed 15 billion on-chain transactions. So we've, I think, hit the milestone moment. Darko, let's start with you. Thank you for being here. You sit kind of at the middle between traditional finance infrastructure and the blockchain space. What do you see as happening, and what do you think that tipping point was?
So it's very difficult to say that to define a tipping point, because what is a tipping point? It will be very much dictated by an asset class that we're talking about. There are asset classes where we have seen scale, and there are asset classes that scale is yet to come. But I think what is happening is that, and people are understanding at the institutional level, that there is a change coming. Now, we shouldn't think of real-world asset tokenization as it has arrived, it's here, everything is going to be on-chain. It's going to be a very evolutionary process. But where a conversation maybe a couple of years ago was, what is this? Now the conversation is, how is this? How is this going to change my process and adoption? And look, we are within the group, within the London Stock Exchange Group, there are many different businesses that have scaled, that are very big. And the conversation that we are having there, therefore, is how do we solve for client problems? And how do we solve them at scale? And that is where trust becomes very important, understanding the client needs. And I don't think that DLT is going to be something like flipping a switch. It's going to be done on use cases, on use case by use case basis. It's going to be done by solving concrete problems. So it's not going to be a massive transition, in my view. But we're definitely seeing acceleration of conversations in that space.
Amazing. Abel, let's go to you at Bit2Me. What is the real institutional demand? You've been around since 2015. You've seen growth. You've been through both bear and bull markets. Where do you see it going now, and what are the differences possibly over the last few years that you've seen scale grow?
Well, the play out is exactly the same that happened over the last decade. When we started, we were serving mainly retail individuals, easy way to buy Bitcoin and to buy the rest of the crypto active that we have. Then a few years after, we started with the corporates, companies starting to introduce themselves and having presence in the ecosystem, but as well as investors. And then, lastly, once the regulation allowed it, in this case it was MiCA, the institutions started to get into the game. The same pattern is happening with real-world assets. We saw the pattern like years ago, and that is why we started like to build a blockchain-based stock exchange, where we are doing the issuance, the distribution, the trading, and the custody. It's called Bit2Me Security Tokens Exchange, and we are just a step away to become fully regulated by ESMA. And the product is thought for funds, companies, and scale-ups that wants to raise capital in a more efficient and liquid way.
Arnaud, over to you. You sit at a really interesting moment as you shared that the data that Dune provides is really used across private public sector plus. When you look at real world assets, liquidity is also a challenge, and understanding on-chain data in real time. What are the changes that you've seen, and where do you think that moment for, if you were looking over the past few years at Dune, what was the moment that really unlocked everything?
So I think the way we look at liquidity in RWA, there's basically 3 tiers overall, right? You have the first tier, which is tokenized treasuries, right? It's about 12, 13 billion overall. You add to that gold and communities, that's another 6 billion. That takes you about 20, roughly. That's, I think, the big key differentiator that happens last year, give or take. So we're 20 billions. This is where there is real product market fit, which was not the case before. Meaning institutional buyers are there, it's real yield, and you also have a secondary market depth. So this is very strong, although it's dominating by, I think, 5 players. If you put BlackRock, Franklin Templeton, Ondo, and a few others, you get to 60, 70% of the market. So this is strong. This is the big differentiator. The data tells you there's a second group, which is more around private credit. Now, private credit, if you guys are familiar with it, it's an interesting, little bit of a paradox when it comes to liquidity, because you have 2 things that are not necessarily opposed. You have the volume of those loans, usually big metrics, 18, 20 billions, but all of that is not liquid. So it's not really liquidity. It has nothing to do with blockchain. It's just the nature, if you guys are familiar with private credit, of what it is. You have locks and mechanism, which make it a very interesting asset. So it is growing. It is tokenized, but it's not liquid. So I think it's a differentiator that everybody should be very aware of. So that's the second category we see in the data. And then the third one, which is just sub 1 billion, it's more like experiments, to be quite frank. I think I put real estate, maybe perhaps in that category. A few other maybe tokenized equities outside of on those products. And that's kind of what the data says. You really have 3 clear tiers, which the first one, again, with tokenized treasuries, generally speaking, that probably is driving most of the liquidity today.
Thank you. Nenter, as we look at you, BitMart powers global flow. And where do you see the need to the point of not everything's liquid and it's the three different areas. I love that explanation. Where are you all seeing the need for real world assets to be offered, listed, and the need for the liquidity?
Thank you. I think that's a great question. So really, when on the liquidity layer side, from a market infrastructure standpoint, I think what really needs to be true for RWA assets to be genuinely liquid and not just listed, because there's a lot of demand for being listed, right? A listed tokenized asset isn't automatically a liquid one. I think real liquidity ultimately means consistent two-way flow. Market makers, they need to be willing to support the inventory, transparent data, and confidence that meaningful size can actually trade without very extreme slippage. I mean, we've all seen products where the fully diluted value looks very impressive, but when someone tries to move a mid seven-figure digit, the spread just explodes and price ultimately gaps 10 to 15%. That's really the difference between what notional TVL is and what practical liquidity looks like. And that's a problem because obviously there's different tiers for different asset classes, but the liquidity from a practical standpoint is still very much important. So for RWAs, the next phase is really building out the full stack around the asset, right? Disclosures and analytics, your connectivity to institutional custodians, eligibility and transfer controls, and market design that supports active trading, not necessarily just symbolic availability. That's important. So a healthier pattern is really when you have that two-way flow, as I mentioned, across different time zones, more depth, multiple independent liquidity providers competing to keep those spreads tight. So when those pieces come together, then I think RWAs sort of stop becoming stranded tokens here and there and really starts behaving more like a core collateral, so to speak, in 24/7 markets.
Can I just make 2 points on liquidity? I want us to avoid falling into a trap of saying DLT is going to bring liquidity, because DLT is just another, or blockchain is just another technology layer. It is not going to create liquidity when there isn't a liquidity. And we shouldn't also forget the fact that for vast majority of RWAs, probably 80-90% of them, there is already liquidity. And it's kind of working. It's a bit maybe clunky. Sometimes it's a bit inefficient. Sometimes it's super efficient. But it's working. So, and this is a debate I get into on panels often. We should be, and I'm a big DLT and blockchain evangelist, we should really be saying, okay, you have all of that. So that's kind of, we're starting from there. Because you can't argue there isn't liquidity in public equity or in treasuries, right? It's like the most liquid securities out there. What we should be saying, you will get that liquidity and what is that and? 24 availability, bigger distribution, better data. These are the things that we should really be focusing, because if we go to head of trading in all the banks, they're all going to say, oh, you're from blockchain world, lovely. Here's the R&D there, go and do some POCs, but I'm going to actually trust what I'm doing right now. So we need to convince those people to get proper scale.
But don't you think, like, if the institution wants to continue adopt this asset class, if there is no liquidity or it's just limited, what's the point? Like, they want liquidity, like, period. Like, what's the point of tokenize something if they cannot find the liquidity?
100%. So, but in many asset classes, they already have liquidity. So what are we bringing to the table? And I think there's many things we can bring. We can definitely reduce the cost. We can make data. We can bring new data sets on the table. We can create new ways of, as you said, end to end that will make the whole thing more efficient. And we can broaden distribution. So I think we should be really focusing on those things. and take liquidity as, well, we have, that's kind of table stakes. We have to have that.
Right, and distribution to other institutions or retail? Because I think I think on the distribution side, the institutions have access. It's really about retail, I guess, when it comes to distribution, right?
But you said they have access, but like if you look at BlackRock build, like there's like 50, 100 holders for like a 2 billion plus. So there's something missing, right? If there's only 100 holders in such a iconic product, so far at least.
Yeah, what we have today is a whitelisted layer of institutional clients getting on board. The problem is much higher than that. Every institution, every company needs to do the whole KYC, AML, everything to their clients. That is inefficient. We need to improve the way exchanges, companies. Of course, there are some protocols, ERCs, that is embedded, the compliance. But it's not the solution. The companies needs to do the compliance. Once you do the compliance and have your identity and can send your identity to other companies, I think that will help a lot of the liquidity, not just for retail, because institutional companies can jump on board more easily.
We could go into a whole digital identity conversation, but I think it's really set up well for Ronghui. If you share me, what CertiK has done over the years is incredible, and you've grown in scale, and regulation is something that we're all discussing. Where do you see the challenges? So I think one of the biggest moments for people to understand is this space is global. We're all implying global liquidity 24/7. There are regulations in different regions, but there's no global regulation as it works. So what are you seeing, and what is your thought, especially as a professor at Columbia? Like, how do you bring this very ethereal concept and the underlying requirement for regulation together?
Yeah, I would say it's a great question. So I think since I'm a CEO and co-founder of CertiK, right, the cybersecurity firm, and also as a professor, I'm privileged to have the privilege to work with regulators closely in the past few years. For example, I serve on the Hong Kong Web3 Task Force Committee. We started to discuss about the stablecoin compliance framework for Hong Kong stablecoin since 2023, actually. 3 years ago, and then they just issued the 2 license last week, right? And I also serve as the technical advisor for MAS, Monetary Authority of Singapore, and we work closely with U.S. regulators, ADGM, VARA, MiCA, and so on. So first of all, as you mentioned, so not only there's no global compliance framework, I would say we started from this year where we started to have some compliance framework. And each region, each location, they have different view over it. Like what are the risks they concern most? Different regions have different concerns, I would say. And also, you can see the framework development took several years, right? Took several years. And even now, they have the compliance framework. There are still lots of concerns. For example, I can give you one example. I will not tell which regulator it is. So last year, when I visited one of the regulator, and just on that day, there is a company doing stablecoin-based credit card business got hacked and lost $50 million, $50 million. And the regulator have no clue about it. They are not aware of that hack. They are not aware that that company are doing business in that region. And a lots of, a stablecoin-based credit card, definitely retail. There are lots of retail users are using that business, and they lost $50 million, and they have no clue about it. And for them, they first need to understand what are all the risks, right? On-chain risk, right? Smart contract hack, oracle manipulation, price manipulation, off-chain risk, like private key management, right? Operational security, and then compliance risk, right? Lots of this mixed together. So first, they need to understand all the risk. Second, they need to be able to, let's say, detect all the risk, right? When something bad happens, they need to be able to detect it. And the third one, they need to, let's say, enforce something, right? They need to take some action. So all these are still very unclear. And that's why if you look at the compliance framework, you will see that many terms are pretty vague. So many companies who want to apply for licenses, they feel like, well, it's hard to prepare documentations, right, reports for these terms, but that's the reality. So we work closely with many companies, big banks or biggest bank like in France and so on, trying to help them on not only cybersecurity, but also on the compliance. But I would say it's hard because, as I mentioned, many terms are still vague.
We have a little over 15 minutes left, and I'm going to open it up to the entire panel to jump in. What are some of the biggest things that you feel our industry at large is underestimating as we look to welcoming traditional finance? And as we've seen, BlackRock, Franklin Templeton, these huge companies, or Fidelity is another, their CEOs and their teams are really leaning into adopting, which is wonderful. But what are some of the biggest things that we are underestimating if we look at the next 3 to 5 years and how that convergence happens?
One area is verification, right? So visibility, even as a data provider, is getting better. But I think verification for this asset class is missing, right? So people, institutions should be able to understand and track the underlying asset behind this, which is not the case today, in a way that's real-time, that's cross-chain. As of right now, you have an issuer that you kind of have to trust to see what's happening. You have auditors that do like a one-time historical snapshot. Again, it's not great, and I think that's why we're not seeing the type of distribution we were hoping, at least for now. It's growing, but on the institutional side of the house. So I think for me, the thing that we are all working on to some extent in the RWA category is being able to provide that verification layer, constant, real-time. No one is really fixing things. This is not like an Oracle price feed type of conversation. It's much bigger. But it needs to happen for those organizations to be able to onboard into greater adoption.
Well, I think the bottleneck here is definitely not the technology. Technology is there. It's nothing challenging to invent. It's the legal structure behind the token. You know, many companies have been focused in tokenizing everything, but the real challenge is like legal structure, alignment with on-chain, and distribution, as we were mentioning before. You've seen in the market, if you really think and read the terms and conditions when they say real-world assets, basically what you are buying is a structured product. And is the perception of the buyer is not that they perceive they're buying like the same, like a bond or a share, but it's not. They're buying a structured product that is held in a very complex way, but a company that it might be not what you initially thought.
Yeah, I mean, I think, look, I want to go back to your point before on compliance and such, because technically, tokenization can move very fast, right? Legally, the institutions do not. So the real friction, it comes down to the identity, suitability, and transfer restrictions into something that's sort of more programmable and interoperable instead of bespoke for every single issue or every single venue. The one pain point today is that, you know, an institution can onboard to 3 different tokenization programs and discover that, hey, each use, you know, it has a different standard for investor whitelisting, for reporting, and you know, so the compliance team has to rebuild the same checks multiple times. It's inefficient. So if we get shared standards for on-chain identity, whitelist and blacklist logics, reporting and audit trails, right? Regulators become more comfortable, and institutions can use that same compliance backbone to, you know, across multiple tokenized markets. So if these programs can converge on a shared identity and reporting standard basis, legal and risk teams could be far more comfortable with scaling that exposure. You know, without sort of that compliance, you're really just running a lot of wonderful pilots, to be honest. And ultimately, I think the long-term winners, they will be the ecosystems that make compliance native to the asset lifecycle rather than just kind of bolting or adding it on afterwards.
So I think one common thread here is trust and resilience. And that is what everyone is going to ask at an institutional level. And woven into that are things like digital identity, but also things like settlement finality. And also, how does the existing world, financial world, which is massive and scaled, how does it interact with the digital world? And that's going to be very interesting. In the UK, for example, we are building a digital settlement depository, which is going to enable that settlement finality through the regulatory framework that is being developed there. We also have our private funds platform that enables that distribution, and soon also secondary market. So it will be very interesting to see how the whole market starts building trust, so that all of the things that we talked separately happen natively and do not have to be thought through every single time. And therefore, as you said, every single time is proof of concept. So we need to move into that launch pad for scale.
Yeah, I agree with all the points, and I can see lots of challenges ahead of us. So as you mentioned, like the standard compliance framework, like can we share lots of the backbone and so on. And but I would say that maybe we can utilize some of the technology. It's still a technology thing. Like for example, we have been working with a U stablecoin backed by Binance on the so-called real-time asset check proof of reserve, real-time proof of reserve. And I would say stablecoin is much easier than many other RWAs. But even for stablecoin right now, it's still very hard to give you a real-time kind of like proof of reserve check. And also kind of like, as I mentioned, so the compliance framework not only we don't have a, I would say, very clear one, and it's very hard to I would say share the compliance framework. So that's why we're working closely with regulators. Actually, we have some contracts from regulators that help them make the compliance framework more clear, and also hope that CertiK can be a bridge between these regulators. That's how about share some of the standard, right, and so on. And one other thing I want to mention is about AI, right? So we have seen the news that's right now, like the missiles model, right, I would say make the hackers, right, their life easier, I would say, right? They can utilize this AI model to find the zero-day bugs and so on. And we have done some research. I think we will publish very soon that after the development of AI model, more and more zero-day vulnerabilities have been found, and more hacks have been done. So there's a threat introduced by AI. So then we also need to defend the digital asset infrastructure also using AI. Otherwise, it's not a fair war. Yeah.
If you look at the concept of the $1 trillion market, right, the next big moment, if we're here a year from now, what's needed to get to that number?
I'll start. One thing we haven't talked about much is the Basel risk ratio. So in traditional finance, you need to hold $1 for $100. If you deal with public blockchain in general, that's about 12x that. So a lot of institutions nowadays, that's why you see like Kinetics from JP Morgan. They start doing permission private blockchain, which I think defeat a little bit the purpose of maybe what we're trying to accomplish. But that's their way to I think go around maybe touching too much. So I think this needs to change if we want to get to that trillion. Another thing that I think is the price differences. Like we see 1%, 2%, 3% price gaps, which is absolutely unacceptable when we think about big numbers on real-world assets. You factor to that, the cross-chain fragmentation that we're all aware. You move capital cross-chain is 3-4% on top of that. this is not acceptable. If you want to reach that type of volume, and this needs to be fixed. For me, those are two elements that absolutely need to change.
I would say that highlight again like portable KYC, that is mandatory. Secondary market will be a real secondary market where bid and ask and allows price discovery. That is essential, like liquidity, real happening over there. And I see two different cases. The bull case, where the stable coins becomes the settlement layer in the next decade, that will allow like the digital interaction more proactive. And the bear case, it will be for me, if that doesn't happen, it will just be more or less the same that we have today, but with better UX.
Look, I mean, if it's purely just limiting it to the institutional side and not retail, I think institutions, like I said, need to really move from that experimental phase to repeated use in treasury, collateral, and fund operations. So a very good litmus test in the next 12 months. It's whether or not internal risk committees can look at a tokenized instrument and say, hey, we know exactly how this trades, how it settles, how it's reported, and how it's supervised, right? In the same way that they can talk about a traditional bond or any other fund. So if the conversation is still dominated by exceptions, bespoke arrangements internally, and one-off approvals, then this trillion-dollar infrastructure narrative really would not work. I think these products need to feel operationally very boring and standard, very predictable, right? Very well supervised and easy to integrate. Then I think the case for tokenization as a true institutional infrastructure layer would actually, have a case.
From cybersecurity perspective, I would say in order to scale it to $1 trillion, we need more, I would say, more efficient and affordable code auditing services or products. So that's why CertiK, we released our AI auditor last week. Hope we can help with that. Second, I think we need also a portal that can help institutions to, easily comply with all the requirements from regulators and so on, and try to get licensed in different regions. And we need that kind of like a framework. Third one, I think we need more practical, efficient on-chain monitoring system, not just AML, not just hack alert, but a more comprehensive monitoring for a possible on-chain, off-chain compliance risk. So that's why CertiK is building our Skynet Enterprise. Hope that can help with it. Yeah.
Everything they said, but I would also add one point, which we used to talk a lot, but we don't talk about it anymore. But we should not forget about it, that we need to have, that there needs to be interoperability, not just between traditional finance and digital finance, but also with the different blockchains that exist. There are 700 blockchains. 400 of them are kind of dead, and 200 are illiquid. So we really need to think about, what are the blockchains? And by the way, we are not going to take a view. We are going to be there to support wherever our clients want us to be. But we need to think about what does it mean to have interoperable blockchains, interoperable traditional finance, because otherwise I always say it's like trying to scale internet. Only internet is actually not talking to each other, and it's not a common protocol, and we can't have that if we want to scale this.
So the trends, if we walk away, interoperability, yes. Digital identity that's portable, yes. Compliance, always. Global regulation, aspirational but hopeful. What's the one other point that we think retail could be a whole other conversation, but what's one thing that if we look at the audience for them to take away in addition to that, what's the fifth thing we should think is important?
Verification, proof of reserve, continuous, real time. That's, I think, what's clearly missing today.
Great. Thank you all. Thank you.
Thanks.
Thank you very much.
Thank you.
Welcome to Signal Week.